Okay, let's unpack this. Thailand, it's always been this prime spot for long-term folks, nomads, retirees. Great culture, low cost, and, well, historically, pretty easygoing about foreign income.
That's right, a really attractive mix.
But that golden era, it seems like it's just hit a wall. There's this massive policy shift happening, and it's basically rewriting the financial rule book for anyone planning to live there long term.
Absolutely. And for you listening, or anyone you know who kind of relies on Southeast Asia as a base, maybe for retirement, maybe for remote work, this is really critical stuff.
So what's our mission today?
Our deep dive today is really about dissecting this dual strategy Thailand's rolling out. First, how they've clamped down on taxes for overseas income for residents there.
Okay.
And second, at the same time, they're pushing out these quite aggressive incentives, trying to lure skilled Thai talent back home, reverse the brain drain.
Right, it's like two sides of the same coin.
Exactly. It's a big national pivot. We need to figure out the impacts, the costs, the benefits for everyone involved.
And we've dug into the sources detailing the specifics of this new tax regime, the documentation burden, which sounds intense, and also those incentives for returning Thais. It feels like a real reshaping of who Thailand wants and how they expect residents to contribute.
It's definitely more than just a minor tweak. This is about funding the state and, well, national talent strategy.
Okay, let's jump into the part causing the most buzz, maybe anxiety.
Yeah.
The tax changes that kicked in January 2024.
Yeah, that's the core of it for many expats.
Before this, the general understanding, the practice, was pretty friendly, right? If you were an expat, you could bring in money, say, savings earned years ago.
Maybe in 2022, transferred in 2023.
Exactly. And that money, when you brought it into Thailand, it was generally seen as tax-free. It was kind of a known loophole, widely used.
Well, that loophole, or that interpretation at least, is now effectively closed. What's interesting is they didn't really change the underlying law so much as issue a new ruling.
A reinterpretation.
Precisely. A revenue ruling that just changes how the existing tax code applies to foreign income. The big change is simple, but profound. All assessable income you transfer into Thailand is now subject to Thai tax. Doesn't matter when you earned it.
All assessable income. So if I earned, say, $100,000 working remotely for a U.S. company last year, but I only transferred $20,000 of that into my Thai bank account for living expenses.
Yeah.
Am I taxed on the full 100 grand or just the 20 I brought in? That's where the confusion seems to be.
That's a really good practical question. And based on what we're seeing, the liability seems to apply only to the amount you actually transfer into Thailand.
Okay, so just the $20,000 in that example.
Yes, but that $20,000 you brought in is now potentially taxable even if you earned it 5 years ago. The key is the whole $100K is assessable, but only the bit you remit becomes taxable upon arrival in Thailand.
Got it. That definitely requires a shift in thinking.
A big one. People need to plan transfers much more carefully.
And this whole thing hinges on that residency rule, doesn't it? The 180-day mark.
Exactly. That's the trigger. Spend 180 days or more in Thailand in a tax year, and boom, you're considered a tax resident for the purpose of this rule.
And it doesn't matter what visa you're on. Retirement, education.
Nope. Purely about physical presence. The day count starts when you land. It hits long-term foreign retirees, digital nomads, even Thais who've lived abroad and come back.
Wow. So for all these people, financial planning just got a lot more active. It's not just about moving cash anymore.
Not at all. It's about meticulous planning and, crucially, documentation.
Right, let's talk about that. The sources really hammer home the implications, especially this documentation requirement. That sounds like a major hurdle.
It's definitely the elephant in the room. Because the tax authorities can now tax any remitted funds, well, they need proof of what those funds are and when they were earned.
So you need records.
Detailed records. Stringent records. Bank statements from your home country, proof of income sources, exact transfer dates, sometimes going back years.
Imagine being a retiree who moved 10 years ago, living off savings, finding decades-old bank statements to prove a transfer was capital, not income. That sounds tough.
It is. It's a significant compliance burden, no question, and potentially really challenging for some people.
Almost seems impractical for some situations. But the alternative, non-compliance, that's serious too. So this documentation burden, plus the 180-day rule, it must be changing how people behave, right?
It absolutely is. The sources strongly suggest we're going to see, or are already seeing, a shift. If staying over 180 days definitely exposes you to this new tax liability.
You could just not stay that long.
Exactly. Some long-term folks, especially those relying on foreign pensions or investments, might consciously decide to limit their stays. maybe 5 months, 5.5 months, just under the 180 days to avoid becoming a tax resident under this rule.
Which, thinking regionally, that could actually boost other countries, couldn't it? Thailand's tax approach used to be a big draw compared to, say, Singapore. Now, maybe less so.
That competitive angle is really important here. Tighter rules in Thailand could absolutely push people towards alternatives.
Which ones?
Well, the sources mentioned places like Malaysia, with its MM2H program, or maybe Vietnam, which has its own appeal and different tax structures. They suddenly look more attractive, especially if your main goal is tax efficiency for long-term stays.
It also means for businesses sending teams or individuals setting up for longer projects, finding those service departments through specialists like moveinstay.com, they now need to add tax consultation right next to accommodation on the checklist.
Absolutely. It's a new layer of complexity for corporate mobility and even individual long-term planning. Tax advice becomes essential, not optional.
Okay, just to be super clear on one point, money earned inside Thailand, like from a local job or renting out a condo you own there, that's always been taxable, regardless of how long you stay.
Correct. That hasn't changed. Thai-sourced income was always and remains taxable in Thailand. The big shift is really targeting that foreign income brought into the country.
Got it. Okay, let's pivot then.
Right.
Because this isn't just about tightening the screws, is it? There's this whole other side. Thailand actively trying to woo its own talent back.
Yes, this is the fascinating counterbalance. While they're making it potentially harder, or at least more complex for some foreigners, they're rolling out the red carpet for skilled Thai nationals abroad. It's a deliberate strategy to tackle brain drain.
A big problem for many developing economies.
And Thailand's feeling it. Especially in high-tech sectors, they need skilled people to drive innovation and growth. So they've created this tailored incentive package.
What does it take to qualify for this welcome hug deal?
The requirements are fairly specific. You need at least a bachelor's degree and critically at least 2 years of work experience outside Thailand.
Okay, so they're targeting people who've gained international skills.
Exactly. Professionals with proven expertise from competitive global markets.
And the carrot. What's the big incentive?
It's a pretty juicy one. A flat income tax rate of just 17%.
17% flat rate. Wow. Compared to the normal rates.
It's a massive reduction. Thailand's top personal income tax rate goes up to 35%. So if you're a high-earning Thai professional working overseas, the chance to come home and pay a flat 17% instead of potentially double that, that's a very strong financial pull.
Makes perfect sense. And it's not just the individuals getting a break, right? Companies hiring them benefit too.
Yes, that's the smart part of the policy design. Employers in designated high-priority sectors, think advanced tech, biotech, electric vehicles, that kind of thing, they get a 50% tax deduction on the salary expenses for these returning Thai experts.
So it subsidizes the hiring costs for companies in the industries Thailand most wants to grow.
Precisely. It makes it cheaper and more attractive for those key companies to bring this talent back onto Thai soil.
When you put it all together, the tax clampdown on foreign income and this brain gain initiative, it really does look like a strategic reallocation, doesn't it?
I think that's a fair way to see it. This talent incentive policy runs until the end of 2029, and it's clearly designed to boost national innovation. You could argue that tightening up on potential tax leakage from foreign residents helps, in a way, pay for this generous program for returning Thais.
A deliberate shift in fiscal priorities. Less focus on maybe older expat savings, more focus on high-tech Thai talent.
It seems like Thailand is making a choice about the demographics it wants to attract and retain. High-value Thai professionals are clearly a priority. And for foreign residents, the message seems to be, you're welcome, but be prepared for stricter, more documented financial compliance. The era of informal arrangements might be fading.
Okay, so let's bring it back to practical advice. For you listening, if you're planning a long stay, maybe already retired there, what are the absolute must-dos now, according to the experts? What are the key takeaways?
The advice coming from tax advisors in the region is pretty consistent and really non-negotiable now for anyone wanting to stay compliant.
Okay, lay them out for us.
Number one, absolutely top priority. Keep clear records. You need meticulous documentation for all money you bring into Thailand. Where did it come from originally? When? Bank statements? Income proofs from abroad? This is now the foundation. You have to prove that money transferred isn't current income earned while you're a Thai tax resident.
That sounds like the biggest headache, especially for people with older savings. What's number two?
Number two, know the dates. This is super important because there is a cutoff. Funds brought into Thailand before December 31st, 2023, so before the rule effectively changed, are generally considered exempt from this new interpretation.
Ah, so there was a grace period, effectively.
Exactly. But if your savings or investment gains landed in your Thai account on January 1st, 2024 or later, they fall under the new scrutiny. That timing difference could mean a huge difference in potential tax liability.
Ouch, a hard deadline. Okay, and the third piece of advice seems obvious, but probably more critical than ever.
Absolutely. Number 3, consult local experts. Seriously, trying to navigate this yourself, figuring out Thai tax law, how it interacts with tax treaties with your home country. It's incredibly complex now. Whether you're there for a long business assignment, using service departments, or settling in for retirement, getting professional, local tax advice is crucial. Don't rely on old forum posts or what worked 5 years ago.
So relying on past practice is basically playing with fire now.
Pretty much, yes. The landscape has fundamentally shifted. Professional advice is key to avoid really nasty surprises.
Okay, so summing it all up, these two big policy moves, the tax tightening and the talent wooing, it feels like Thailand is signaling a move away from being this kind of casual, easygoing residency hub towards something more structured,
Yeah.
more formal.
I think that's right. More aligned with international standards, perhaps like OECD norms for tax compliance. It's just a more serious fiscal environment.
And the result could be a change in who actually chooses to live there long term.
Very likely. We might see more people adopting shorter-term strategies like rotating in and out every 6 months to avoid hitting that 180-day tax residency threshold.
The visa run takes on a whole new meaning.
Kind of, yeah. And regionally, as we said, those countries may be offering simpler or more lenient tax rules could gain an edge, especially for retirees prioritizing financial simplicity.
Which leaves us with a big question, doesn't it?
It does.
Thailand still has so much going for it. The lifestyle, the culture, the relative affordability, the infrastructure. It's still incredibly appealing.
Yeah.
But now, with these tighter financial rules, the need for careful compliance, potentially higher taxes, will those quality of life benefits continue to outweigh the increased financial and, frankly, bureaucratic burden for the typical long-term resident or retiree?
That's the million-dollar question, isn't it? How individuals weigh those factors will likely shape the future expat landscape in Thailand.
Something for you to definitely think about if you're considering your next move or planning your future there.